Good day, fellow investors. There was a recent Bloomberg conference and I have free Bloomberg videos for you to watch to really understand the long-term implications of the current financial environment. We have Gundlach, Paul Tudor Jones and Jim Chanos. I'll put the link to my playlist in the description below in the first comment, so enjoy this video. It is about 1 hour, but you will really get the nitty-gritty of how the financial environment works now, the key risks, and also the long-term opportunities. I'll quickly here touch on my summary on how I see things, so you might first watch those videos, then come back here, or first this, and then really understand better the videos. The thing is, from Gundlach speaking how the Fed is cutting rates and now interest rates for the long-term bonds are going up, which is then another signal of where we are going, how bonds are not safe anymore because of that, because of inflation, the risk of the 25 trillion net non-US foreign market position. So 25 trillion has been bought by foreigners in the US. If that money starts going out, well, that's 40–50% of the market. The only solution is more quantitative easing coming for servicing debt, interest payments. That usually leads to an inflation spiral. And we have also been seeing now the paradigm shift going from US dollar safety to gold, because gold has almost doubled recently. And you can see here the key with interest and debt is that everything was great while interest rates were almost zero and even below 1%, on average 1.5%. However, we are now 3x from the lows, and that means that that is much more expensive debt, which leads to a financial reckoning down the road. The markets are getting more expensive, but given the reckoning, there will be a great buying opportunity ahead. He says it feels now like 1999 or 2007. You can really listen to the video and see how things look like, because he has been there in both those cases. It also takes forever for issues to arise. Speaking of AI, he spoke how the winners were in the early 1900s were electricity stocks that underperformed since 1911, similar to internet stocks since 2000. Private credit is in a terrible position already. Harvard is selling private equity and needs to borrow to finance its living, even if it has 53 billion in the endowment. Private credit pitch is that it is less volatile. That's irrelevant, not valid. It was cheap, now it is not cheap anymore. There has been overinvestment, low liquidity, and this is a theme that you will see summarized at the end of this video. There is no excess reward anymore. It looks like CDOs in the 2000s. When it comes to forward selling, it will be ugly. Therefore, as investors, we can wait for better opportunities. The market has not broken yet, but don't be surprised with 30–40% drops on bonds and consequently even more than stocks. When he says it's not going to take 5 years, it's getting closer, the treasury issue will be bigger and bigger, and therefore it will break sooner. This is the key. The treasury problem will be bigger than now. We have to restructure everything because this is not sustainable. These are normal waves of history in line with what is Ray Dalio saying about the cycle. There will be nowhere to hide. A long-term investment theme, he says, India, development growth there, gold, Bitcoin, and then foreign emerging markets at a fair price. The next one to discuss is Paul Tudor Jones, how short-term, more tactical than Gundlach. Short-term, you should actually go long, because in a year, the Fed Chairman Powell will be thrown out of office, and someone new should come, which will be much more dovish, lower rates, which could push stocks even higher for a while. However, we are in a deficit of 6% forever, but there are fiscal constraints, and then when it comes to that, the playbook is standard, more quantitative easing, and the standard story, run deficits for growth. He discusses also how the budget is impossible to balance. Just to put it in perspective, the bond vigilantes will wake up at some point, and this, where we are living in, this show is not real. 6% or even 7% deficits in a good economy that we are running now are not sustainable. Valuations will not be where those are now. Lower rates, but a steeper yield curve, so that is something. The dollar will also be a lot lower with lower rates, so you can also watch that if you have exposure. If you want the portfolio to fight inflation, a mix of stocks, gold, Bitcoin, he's more of a macro player than Gundlach, and inflation running hot to tax the consumer to get out of debt. Equities up, as he said. If rates drop temporarily, could be up because the world is okay with the suspended reality. AI growth is impressive and it's growing at a few percentage points every quarter. Therefore, it could also lead to 10-20% unemployment in 5 to 10 years. The big problem is inequality. Same those waves that Gundlach has been discussing. Now, very interesting on Chanos, more on the financial excesses that all what we have discussed earlier with Gundlach and Paul Tudor Jones reflect, and Chanos gives you the nitty-gritty of the details there. Of course, Tesla, robotaxis, the cost models, over-exuberance in thinking, the golden age of fraud in that Wall Street sells everything. We have had SPACs, NFTs, meme coins, even the president is selling so everything. But insiders are selling more and more because they also see it's better to run for safety. He explains short Carvana, and the strategy is to go short strategy and long Bitcoin, and then he discusses there his feud with Saylor, how he is just a salesman. So that's something very interesting to see, and then we'll see whether this bubble will keep on going on forever or the excesses will be punished. But the situation is that we are in an unsustainable system. Fake reality is better than reality. Nobody wants to talk about the things we are talking here because everyone is long. As Ray Dalio also says, everyone is fundamentally long everything. Private credit, private equity, markets, valuations, price doesn't matter anymore, just where it is going next. There are these tail excesses, even structural problems. When will it break? We don't know, but if we go back to Nassim Nicholas Taleb, the market is like a large movie theater with a small door, and the best way to detect a sucker is to see if his focus is on the size of the theater rather than that of the door. And then the key question is, when will this happen? Everyone is now focused on the size of the theater, not on the exit door. From Bitcoin, from private credit, from private equity, even from the stock market. 25 trillion of foreign ownership on a 59 trillion market. Whoa, the exit door is not there, absolutely. So that is the thing. The key questions are, of course, nobody knows when, timing, I don't know, the magnitude of the crashes, nobody knows. Will it be a boom bust? Will we go again 100% up in the next few years? Impossible to know. What will be the levels of inflation? First 2 years growth, great years on Trump spending and everything. And then only in the future more treasury issues. Will be 29 or 20. It's impossible to predict. That's the key, and that's why nobody cares. When it comes to value investing and the solution, well, if you invest with being rewarded from business ownership, dividends, earnings, asset values, real protection, then you will do well no matter what. You need to invest also to have a margin of safety. You need to go to the pockets where there is still value. And Gundlach gives an interesting idea to go long India and emerging markets. Because if you look at the world today, look at this. we are constantly talking about 1.3 billion people versus the other 7 billion in the rest of the world. Everyone is focused here. US, Europe. I mean, we are just a drop in the world. Therefore, India can also be indirectly invested through commodities. If you can find cheap commodities with a margin of safety, there is plenty of volatility to do that. We have discussed some stocks, Pabrise, coal picks, which are again interesting for the long term. Also, in my diversified portfolio, I have already reached 20 interesting value ideas. You can check that on my research platform, but I'll also present a little bit more of that during this week. So thanks for watching. I put the Bloomberg playlist here. Thanks, and I'll see you in the next video.